We really look forward to spending some time with everybody on the line today talking about some of the sales opportunities that exist out there for the Indexed Universal Life. There's nobody out there that does a better job than Charlie Gipple. I think you'll find him to be a great reference to really learn the ins and outs of these ideas and this marketplace, along with the folks at URL. Obviously, Matt's an industry expert himself, a wealth of knowledge there. So, we're here to help educate you guys, help give you guys sales opportunities that you can take out to the field and really give you actionable items. So with that, Charlie, I'll turn it back over to you.
Awesome. Thank you, Rob. I appreciate that. And thank you, Matt, for your partnership. And thank you to URL as an organization for the longstanding partnership here with Genworth. Yes, my name is Charlie Gipple, and I'm the National Director of Index Products here at Genworth, calling from the frozen tundra of Iowa. So it certainly is nice to be inside here doing this webinar with you fine folks. Really what I want to talk about here is 4 different things. First and foremost, why is it the perfect storm for Indexed Universal Life Insurance? When you look at the life insurance business over the last 30-year period of time, you'll see that it's gone from a $9 billion business back in 1985 to a $13 billion business as of the end of 2014. One would look at that and say, well, Charlie, that means that it's grown by $4 billion. Well, not necessarily, because when you take into consideration inflation, it's kind of a sobering story, right? It's actually 40% smaller than it was back in 1985. So you have this industry that unfortunately has been stagnating. I think it's going to grow in the midterm future, but it has been stagnating over the last 40-year period of time. But there is one product that has absolutely flourished over the last 15-year period of time, especially over the last 4 or 5-year period of time, and that is Indexed Universal Life Insurance. From 2009 to 2014, it's actually grown, the industry, the IUL business that is, it's grown by about 200% over that 4-year period of time, or 5-year period of time since 2009. Today, when you look at the universal life insurance world, it is 50% comprised of Indexed Universal Life Insurance. So even though UL has been around since 1979 and IUL is an infant relative to UL, well, today, Indexed Universal Life Insurance, which has only been around since 1997, is actually more than 50% of the entire UL business. So it's a huge success story. Why is that? That's what I want to talk about first. Secondly, what I want to talk about is sales ideas and stories. I believe in telling stories. I believe that we are not so much in an analytical business as we are in a storytelling business, because there has never been a decision that's been made that is an important decision without emotions involved. So I certainly like to tell stories to you guys. I also like to talk with you guys about how to tell stories to clients, and this is something that I've spent thousands and thousands of hours researching, is the storytelling and how to give a message that is a complicated message, how to give it in a simple manner to the clients in the form of a story, because stories, they work. And I would argue that if you have 10 of the country's top life insurance salesmen, and if you ask each of those salesmen, what would you put within the top 3 of the things that have made you most successful? I would argue that probably every one of those 10 top producers would have within that top 3, I'm good at simplifying the complex, or I'm good at telling stories. We are in a storytelling business, so I want to talk with you about some life insurance stories as well as sales ideas around Indexed Universal Life Insurance. Third, I want to give you 3 calls to action. Always want to make sure that as soon as you hang up, you have something to call to get, because what good is it if I talk about these great sales concepts and ideas if you don't utilize them? How can you utilize them? How can I get you to utilize them quicker? By calling to get the material that backs these particular concepts. So that's a third thing I want to talk about. And then lastly, I'll end with some stories from, not me, but the Kinder brothers. If you've been in the life insurance business long enough, you know who the Kinder brothers are. They're legendary insurance salesmen. They've written books that are legendary around life insurance sales. I want to give you 3 stories for that client that says, I don't need life insurance. And I know every one of you on the phone has probably gotten that before. I don't need life insurance. How do you talk with that client? What are the 3 stories that the Kinder brothers suggest using for that objection of I don't need life insurance? So first of all, let's jump into the last 15-year period of time. And Matt and Rob, can you see this okay? Did it register on your side?
Yes, yeah, it
It's going through. Perfect, perfect. Just want to make sure before I go on here. Okay, so the last 15-year period of time, it's been an interesting go, right? The market has been chopped in half twice over the last 15-year period of time. Forget the last 15-year period of time. Look at that first 10 years of the new millennium. Do you know that if you put $100,000 in 2000, that $100,000 would have turned into $79,000 by 2010? So by 2010, which I'll get my marker out here and mark it, somewhere around right here, your $100,000 at the beginning by investing in the S&P 500 would have been worth $79,000. In other words, you would have lost 21% of your money. Now, if that's not catastrophic enough, what if you also took into consideration inflation? And I actually wrote a white paper on this that'll soon be out. But I took this decade and I wrote down all the data and the analytics behind this decade and why consumers feel, well, with unemployment less than 6% now, why is it that consumers just feel kind of crappy, so to speak? Well, over this decade, that $100,000, yes, would have been reduced to $79,000 as a result of the S&P 500, but what if you also looked at inflation? Because $79,000 at the end of the decade would not have been $79,000 at the beginning, right? How much would that $79,000 at the end of the decade actually be worth from a purchasing power standpoint relative to the beginning of the decade? It would be worth $60,000. So your $100,000 would have had the purchasing power of $60,000 after it rode the stock market down 49%, up 100%, then down 57%, and then up a little bit there in 2009. $60,000. Now, ask yourself this question. When was the last time that over a decade one lost 40% of their purchasing power in the stock market? Was it the 1930s? Was it the Great Depression? No, because during the 1930s you also had deflation, which means that money was actually getting stronger, right? So you had that offset to the bad market, which was a good thing. What about the 1970s? The 1970s is closer than the 1930s because, yes, you had a bad stock market in the 70s in addition to that huge inflation, but still not the same as what we experienced from 2000 to 2010. Never, ever, ever have we experienced a decade to where over that 10-year period of time, consumers lost 40% of their purchasing power by investing in the S&P 500 or investing in the United States stock market. Now, here's something that's even more catastrophic, and then I'll get to my point here as opposed to being the Debbie Downer. You're probably thinking, who invited Debbie Downer to this party? But what's interesting is net inflows into equity mutual funds and equity ETFs. What do you think the record year was? And this is, of course, as of the end of 2013, the last part of this chart. As of today, the market is not up 173% from March 2009. It's actually up 209% as of about a half an hour ago relative to March 9, 2009, a huge run-up. And by the way, the bull market that we're in, it's about 72 months old. The average bull market lasts around 48 months, right? So we're 209% up, and we are 72 months into this bull market when the average bull market usually lasts about 48 months. But here's something that's interesting is what do you think the record year was for equity mutual funds and equity exchange traded funds? Well, the record year was right here in 2013, right? I don't have 2014's data. Maybe that broke yet another record. Now, what was a prior record prior to this peak right here for people buying equity mutual funds and equity ETFs? Well, it was right here, right? It was in 2000. Now, so we have two of these three peaks covered. Now, let me ask you a question. Prior to 2013, there were many years to where equity mutual funds, stock mutual funds that is, and stock ETFs did not experience any net inflows. They were net outflows, meaning more people took out than put in. Well, prior to 2013, when was the last year that we had any net inflows into equity mutual funds and ETFs? Right here. So in other words, where do people buy stocks and buy equity mutual funds and buy equity ETFs? They buy here, they buy here, and they buy here. When do they sell? They sell here and they sell here, right? People, they buy high and they sell low. So not only have consumers lost a huge chunk of the purchasing power of their money over that 10-year period of time and 15-year period of time, because of the market, because of inflation, they've also bought high and they sold low over that period of time. So my first statistic, my first idea is this. If you have that consumer that does not want to listen to you when you talk about index annuities or doesn't want to listen to you when you talk about indexed universal life insurance. Why? Because they think they can time the market and they can do it perfectly. They can do it better than anybody else. If you have that consumer that thinks that they're a day trader, use these statistics right here. From 1990 to 2005, the S&P 500, it averaged 11.5% per year. 11.5% per year over that 15-year period of time. But what if you missed out as an investor? What if you missed out on just 20 of the top trading days? Just 20 of the top trading days over that 15-year period of time. What if you missed out on 20 of those top trading days? Would you still get 11.5% average return over that 15-year period of time? No. What would you get? You'd get 5.4% just by missing out on 20 of the top trading days. What if you missed out on 40 of the top trading days? What would you get? Would you get 11.5%? No, you would get 1.1%. Said another way, 96% of the growth in the market comes in only 1% of trading days. Again, 96% of the growth in the stock market comes in only 1% of trading days. This is why buying high and selling low, that's why it's so prevalent, because it is so hard to time the market. Why? Because that window of opportunity is so small. Let's talk about indexing here real quick. Let's talk about indexing. Do you know that of those 10 years, over that catastrophic 10-year period of time, that 6 of those 10 years, the market was actually up? Only 4 of those 10 years was the market actually down. So what if you were to say, you know what, let's assume that we have this product, and this product, when the market drops, you get a 0 credit in that year. But you know what? When the market goes up, you would get everything that market does to the up to, say, a 14% cap. So in other words, these first 2 years, you get a 0 in that first year, a 0 in the second year. Now, one note of caution here is you would also have cost of insurance charges if we're talking about IUL, which clearly I am talking about IUL. So you would still have some charges there, but the interest credit that you would get in that year would not be a negative 49% over that 2-year period of time. It would be a 0, right? So year 1, you get a 0. Year 2, you get a 0. But you know what? In that next year when the market goes up, wouldn't it be nice if that client got everything the market did to the up to a 14% cap? The next year, the same thing. Next year, the same thing. Next year, the same thing. What would you have at the end of that 10-year period of time? Instead of $79,000, what you would have is somewhere around $170,000, right? Over a 10-year period of time, compounded, that's what, probably around 6.5% per year. So in a market to where the market actually finished down 21% over a 10-year period of time, imagine averaging 6.5% return. Again, without incorporating COI charges. I would incorporate that in here, but there are a million different scenarios based off the client's health, the age, male, female, stuff like that. I want to simplify this. That is the power of indexing. The power of indexing is this. Will you ever get 100% over a 1-year period of time or a 5-year period of time? No, you will not. But you know what? Neither will you get a negative 40% return over a 1-year period of time, which is what happened in 2008 if you're in the stock market, right? Almost a 40% negative return in that particular year. In other words, with indexed universal life insurance, it's not about the amount of return on your money. It's about the amount of money you're getting the return on. Again, with IUL, it is not about the amount of return on your money. It's about the amount of money you're getting the return on. You will never lose 20%, but at the same time, you're not going to gain 20% in a given year either. It's a trade-off, and that's a trade-off that's paid off pretty well since the existence in 1997 of indexed universal life insurance. Now that quote, that works very well with consumers. I've actually done a lot of consumer research to where we bring actual consumers into a room. There's a 2-sided mirror, and they have those little politician, the dials, right? So I'm behind this 2-sided mirror, and I have this TV screen that shows the feedback of all 20 of these consumers. And we have an actor that goes over a script, and a lot of what I'm going to talk about today is in that script. when you say it's not about the amount of return on your money, it's about the amount of money you're getting the return on, that dial, it goes absolutely off the charts. So that works with the consumers, especially those consumers who say, you mean with IUL I can't get 50% in a given year? Well, but let's look at history and let's look at the fact that, you know what, it's about the amount of money you keep. It's not so much about the growth. Need to erase some of these drawings from the prior slide here. So you have this fear, the fact that the market's been chopped in half twice over the last 15-year period of time. But where is the consumer to go if they're afraid of the market? Look at interest rates today. As of today, the average one-year CD is 27 basis points, average five-year CD, 80 basis points. Now, we're not talking about CDs, we're talking about life insurance, but of course, prevailing interest rates also flow through to life insurance fixed products, right? So where is the consumer to go? And by the way, I looked at this and I said, let's see, 27 basis points, rule of 72. How long does it take for a consumer's money to double at a 27 basis point rate? Punch that into your computer, 72 divided by 0.27. It would take 267 years for that client's money to double. Rates are extremely, extremely low. So as a result, where are consumers to go? Well, many consumers, they're going into indexed universal life insurance, right? Now, as Warren Buffett, my fellow Midwesterner here says, rule number one, never lose money. Rule number two, never forget rule number one. And he's not just talking about those market corrections in which we've had two significant corrections over the last 15 years. He's also talking about inflation, right? There's also an inflation rule of 72. Use this with your consumers. What if you took 72 and if you divided the inflation rate into that? I'm going to draw this here. What if you took 72 and divided the inflation rate into that? So let's say the inflation rate going forward, it's 3%. What's the outcome of that? That's 24, right? What does that 24 mean? What this means is Mrs. Klein, as a result of inflation at 3% going forward, that means that in 24 years, your $100,000 will only have the purchasing power of $50,000. That tells you how long it takes for your money to be chopped in half by the erosion powers of inflation. And heaven forbid, should inflation go to, say, 6% or something crazy like that, that means that in 12 years, unless you have an inflation hedge, that means that in 12 years, your $100,000 will only have the purchasing power of $50,000. Inflation is dangerous. Why is inflation so dangerous? Because it is so subtle and it is so gradual. My pastor told the congregation once, he said, listen to this, think about this, and live by this. He said, whether it's failed marriages, failed governments, failed finances, he says, always remember this phrase right here. And he said something pretty profound in my opinion. He said, subtle and gradual steps of erosion always lead to severe consequences. Subtle and gradual steps of erosion always lead to severe consequences. He said, what do I mean by that? He says, here's what I mean by this. Governments, they don't just fail overnight. Marriages, they don't just fail overnight. Finances, they don't just fail overnight. It's those subtle and gradual steps of erosion, of bad things happening. They're so dangerous. Why are they so dangerous? Because you don't even realize they're happening. Then one day, boom, you wake up, your husband doesn't like you, your wife doesn't like you. You know, depending on whether you're male or female, you know, governments, they fail. Why? Not because something happened overnight, but because of those subtle and gradual steps of erosion. That is inflation. Subtle and gradual steps of erosion are so dangerous because you don't even notice them. The Grand Canyon. The Grand Canyon was created by the Colorado River. Thousands and thousands and thousands, millions of years of subtle and gradual erosion. Why? Or what is my point there? It created the Grand Canyon. Mrs. Klein, my job is to make sure that we have a hedge against inflation so you don't wake up someday with a hole in your purchasing power the size of the Grand Canyon. But also taxes. Taxes can also erode the wealth, right? We are $18 trillion in debt as a nation. And think about this, $18 trillion in debt. How big is a trillion? We get numb to these numbers, right? How big is a trillion? Well, if you went back in time 1 million seconds, it would have been 12 days ago. But what if you went back in time, and use this with your consumers, this is pretty intriguing. If you went back in time 1 million seconds, it would have been 12 days ago. If you went back in time 1 trillion seconds, what year would it be? It would be 30,000 BC. In other words, 1 million seconds ago was 12 days ago. 1 trillion seconds ago was 32,000 years ago. We are $18 trillion in debt as a nation. And there are a few things that the government can do to get us out of this debt, one of which is to raise taxes. What do I think is going to happen? Well, I think the taxes relative to where we are today, which we've been kind of spoiled, I think the tax rates are going to go up. Wouldn't it be nice if you could put money into a particular solution and eventually take money out of that particular solution 100% tax-free? Or you could put money into a solution, and you know what? If you pass away, 100% tax-free death benefits go on to the heirs. Wouldn't that be a great concept? This is why I said at the beginning, I think that life insurance is going to skyrocket over the next couple decades. Why? Because of the tax-free nature, the tax-free benefits that life insurance has in it. That leads me into an idea here. So what you have, let's talk about accumulation. So there are two different types of life insurance policies. When you look at indexed universal life insurance, there are two different types, right? There's an accumulation sale, meaning the client just wants to cram in as much money as possible and then eventually take out for retirement or what have you as much money as possible, 100% tax-free. But then you have the death benefit sale, which is the opposite. They want to put in as little of money as possible, but eventually have as big of a death benefit as possible. Why? So that, well, when they pass away, they've had the cheapest death benefit possible that goes 100% tax-free to the heirs. Let's talk about the first one here, which is the accumulation and distribution sale, which is about 80% of the indexed universal life insurance sales numbers. So when you look year after year, and this has actually grown, 2014 LIMRA estimates are this: 80% of the IUL business, it's to overfund the IUL, as little of death benefit as possible, cramming in as much money as possible. Why? So that someday you get tax-free distribution. So let's talk about this, then we'll go to the death benefit concept. So Mrs. Client, here's my job is easy, Mrs. Client. My job is to keep you as high on this chart as possible. Now, when we're talking solely about taxation, that is my job, to keep you as high on this chart as possible. Now, there are other things to take into consideration, like expenses and stuff like that, but I'm purely talking about taxation with my chart here that I call my money elevator. My job is to elevate you as high on this chart as possible from a taxation standpoint. 4 different types of money. The first type is free money. You know, free money, it's obviously the best. If I could give you all free money, I would. If I had the ability to do that, I would. You know, free money may be inheritance. Maybe, you know, you have a rich uncle that passes away. You know, you get that money free. Or maybe you win the lottery. That's the best money, right? You also have something in there called the 401k match. Now, Mrs. Client, if your employer matches you up to 6% of everything you make, you better make darn sure that you're putting in at least 6% of what you make. Why? Because that is a 100% immediate return. That is a form of free money. Now, let's go down into that second rung of the ladder here. I've looked all over the entire world here, and for the most part, I've found 3 different types of tax-free money. 3 different types of tax-free money. Municipal bonds, to where that interest is tax-free. Second type is Roth IRAs, to where you can actually get interest and take distributions eventually that are tax-free. And the third type is life insurance. And this is life insurance done correctly, right? It cannot be a modified endowment contract. 3 types of tax-free money. Well, the third rung down is tax-deferred, of which the largest category here is the alphabet soup of retirement plans, right? You have 401k, $3.2 trillion in 401k plans. Why? Because they don't have to pay taxes when they put that money into the 401k. People love that. The 401k plans, simple plans, set plans, IRAs, you also have annuities there. And the last rung down on the ladder is money market funds, mutual funds, savings accounts, CDs. And by the way, maybe next appointment, you know, we could talk about bringing you up a rung, because you have $100,000 in CDs. Maybe we can bring you up and talk about annuities sometime in the future. But that is not the topic of conversation today, Mrs. Klein. Now let's compare and contrast free money versus tax-free money. Let's use this example. Let's say that you have in your 401k plan a certain dollar amount. Let's say that you have a match of 6% there. But you're putting away, say, $5,000 above and beyond that match. Now, again, life insurance, Roth IRAs, et cetera, they're not an alternative for 401ks because you have additional expenses, et cetera. I just want to talk, however, about taxation. I want to talk purely about taxation. Now, when you contribute above and beyond that 401k match, where is that 401k contribution going? Is it going into the tax-free bucket here? Or is it going over that tax-free bucket and skipping down into the tax-deferred bucket? When you think of 401k contributions, what is happening? What's happening here is it's going into that tax-deferred bucket. And my apologies, this pen is very hard to use when I'm using the mouse here, so if it looks sloppy, it's because it's kind of cumbersome here. So what you are doing is you're skipping over that tax-free bucket or that tax-free rung of the ladder, and you're going into the tax-deferred rung of the ladder. What are the implications of this happening here? What are the implications from a tax, purely a tax standpoint, of going into tax-deferred versus tax-free? This is where the next slide is very important. And Mrs. Klein, if you get only one thing out of this presentation today, make sure that it is this part, because this slide right here, this drawing that I'm going to draw you, is the most important thing that I'm going to show you today. And many consumers, many investors, they are unaware of this. You see, here on the left-hand side, you have a tax-deferred example, so your 401k or an IRA if you can contribute to an IRA. On the right-hand side, you have life insurance, for example. Or if you make a small enough amount of money, you can contribute to a Roth IRA. You see, the IRS requires that you make less than, let's see, this year it's $191,000, I believe, adjusted gross income. If you make less than that, you can contribute to a Roth IRA. So on the left, you have tax-deferred. On the right, you have tax-free. Now, question for you, Mrs. Client. When you put money into that 401k plan, has that money been taxed up to that point in time? No, it hasn't, right? It's tax-free up to that point in time. This is why people love 401k plans. This is why people love IRAs, because it's excluded from your income in that particular year, right? But go over here. What about the tax-free money, whether it's a Roth IRA or whether it's life insurance? Has that money been taxed up to that point in time? Absolutely. It was taxable somewhere along the way, right? So you've paid taxes on this side right here, but you have not paid taxes on this side. But Mrs. Client, question. The question is this. When you take money out of this, say 20, 30, 40 years from now, when you take money out of it, is that money taxable at that point in time? Absolutely it is. What about this over here? When you take money out of this 20, 30, 40 years from now, is it taxable at that point in time? No, it's not. You see, Mrs. Client, here's the thing. The thing is right here, you're paying taxes on the seed, and right here, you're paying taxes on the harvest. Had you rather pay taxes on the seed, or had you rather pay taxes on the harvest? Most people will say that if they have the opportunity to, they're going to pay taxes on the seed as opposed to the harvest, right? And again, that's one of those phrases to where those dials, they absolutely go off the charts. So how do you do this? Well, this is through something that we call Indexed Universal Life Insurance. And Indexed Universal Life Insurance, what I can do is I can show you an illustration of what that potential seed is, what the potential harvest is, and what all this means to you. So Mrs. Client, would you allow me to run an illustration for you? Don't you think that is a good segue into an illustration? Many people would argue absolutely it is. So that's where you can run an illustration or call URL to get an illustration on a particular client. What is their seed? What is that potential harvest eventually? And what is that death benefit? So that's an accumulation and distribution conversation, right? Seed versus the harvest, as well as tax rates. Tax rates are going up. 32,000 years is 1 trillion seconds. Let's kind of shift gears, though, and let's talk a little bit about the death benefit. So here at Genworth, we have two different products. And again, this is pretty much the industry, right? 80% of the industry is a blue box here. It's our Asset Builder. Our Asset Builder product, it's a great product for accumulating and distributing assets tax-free to the consumer. Now, very important, next Monday, which is the 23rd, we are going to make the Asset Builder even more attractive. It's going to have a persistency bonus, which means that if the client is in the policy for more than 11 years, there's going to be a 35 basis point persistency bonus. And what that's going to do is as that money grows and grows and grows, say 20 years into the policy, 30 years into the policy, it's going to make a huge difference on distributions. But another thing that the Asset Builder is going to have, which our Asset Builder right now does not have, or Asset Builder 2 is going to have, in which Asset Builder 1 does not have, is different cost of insurance charges. In other words, we're going to tweak the COI charges so that eventually, over the long run, the client is going to be able to take even bigger distributions. So those two things together, the resloping of the COI charges as well as the persistency bonus, what it's going to mean is clients can take even more money from their policy than they can from the Asset Builder 1 right now. But two different types of policies we have. We have the death benefit product and we have the accumulation product. A lot like if you're golfing. You can't golf with just a driver, right? Each product has its own purpose. So a driver is for driving the ball. A putter is for putting the ball. Let's talk now about the putter. Let's talk about the foundation builder here. This policy, it has up to a 30-year no-lapse guarantee. Does it have to 121 no-lapse guarantee? No, it does not. Why did we choose a 30-year no-lapse guarantee? Well, there are a couple reasons. One of those reasons, however, is the trade-off. The trade-off in cash value as well as the premium requirement from the client. There's a big trade-off in order to have a guaranteed age 100, right? Let's talk about those trade-offs. But before I go there, I want to show you a slide here. Both of those policies, the foundation builder, which is our death benefit policy, and the asset builder, which is our accumulation policy, both of those products have 4 different strategies. So the client can choose amongst 4 different strategies. All these strategies are just the straight S&P 500. We chose the S&P 500 for a lot of reasons, one of which is very simple for the client to understand. The second reason is because that is where a huge bulk of the industry sales are going, into straight S&P 500 strategies. But you have a 14% cap on the 1-year cap-based strategy. The 1-year cap plus strategy has an 18% cap. You may be thinking, well, what's the difference, Charlie? The difference is at the beginning of that 1-year period of time with the cap plus strategy, that client has to pay a fee of 1%. So in order to get this 18% here, the client has to pay a 1% buy-up charge at the beginning. So if in that segment, if in that strategy, the client has, say, $10,000, that client at the beginning of the year would have to pay, let's see, $100. But what would they get in exchange for that $100 that they paid for? They would get an 18% cap. So that's for the client that's a little more on the bullish side, right? We have a 2-year point-to-point strategy with a cap of 50%. So one would think, well, if the 1-year cap is 14%, then why would the 2-year cap not be 28%? Well, long story short, when we buy the options from the investment bank, the insurance company, it's kind of like a volume discount, right? We can buy more for less money by going out 2 years. So day 1 versus day 730. What did the S&P 500 do over that period of time? We can get a higher cap on that particular strategy than we can day 1 versus day 365. And then the fourth and certainly not least strategy is the monthly average strategy. Again, on both of our policies, it's the exact same. Now on the Asset Builder 2 next week, the cap is not going to be 14%. We're going to have that decrease in exchange for some other benefits in the policy, which I alluded to, but there are going to be some other benefits beyond that as well, such as lower loan rates. So even though these are the caps on the Asset Builder 1 today, Asset Builder 2, it's a completely different product, and it's going to be tweaked a little bit, not just from an expense standpoint, but also from a cap standpoint. Now, let's talk about a death benefit concept here. I want to talk about the value triangle here. So here you have Bob and Nancy. You know, this is a client that's age 60, or a prospective client who's age 60, Bob. He's married to Nancy. They have $7,500 per year to help them achieve a solution to a potential problem they have. What is their potential problem? Well, the challenge is this. They just invested in a coastal home near their grandchildren, and this home costs, let's say, $500,000. What happens if Bob dies? If they have a mortgage on a home of, say, $500,000, what happens if Bob dies? Does Nancy have enough money? Does she alone, would she alone have enough Social Security income, if she was taking Social Security, to pay off that mortgage or to pay that bill? You know, when I worked at MetLife, my old general manager, he said this. He said, anytime anybody brings on a significant load of additional debt, there is likely an additional load of life insurance needs. Anytime somebody brings on an additional load of debt, there is likely an additional need for an additional load of life insurance. He says, what do I mean by that? Well, if Bob, in this case, were to pass away with a $500,000 mortgage and if Nancy wasn't making as much as both of them combined, and the inheritance that Nancy got was not enough to pay off, to comfortably pay off that house, then what's Nancy to do? Well, an idea is this. What if they bought a life insurance policy, say a foundation builder IUL, for $7,300, $7,364 as a matter of fact? What that can do is that can buy a $500,000 death benefit. Now, many may be thinking, well, yeah, but if the death benefit is the only need in this scenario, why not just go with guaranteed universal life insurance? This is where I want to talk about the differences between GUL and indexed universal life insurance. And we offer both types of these policies, but I want to show you the differences between IUL and indexed universal life insurance. I'll start with a quick story here. So when I talk about this, it reminds me of me and my wife. A couple years ago, we were in the market for a new vehicle, and the vehicle that I had in mind was something that that has a lot of horsepower. I like to play with our boat. That is our #1 hobby, to take the boat out on the lake and tow the kids around on the tube and skis and stuff like that. And as you know, boats are heavy. It takes a pretty good vehicle to haul a boat. So I'm thinking about a pickup truck, right? I'm thinking about a pickup with a lot of horsepower. I like to do yard work, throw stuff in the back of the bed. It's a pretty versatile driving instrument. My wife, on the other hand, she's a stay-at-home mom. She's always hauling around our kids, soccer balls, all this stuff, as well as a million of their friends. So she has a particular automobile in mind. And what do you think that automobile is? It's a minivan, right? So we go into the dealership, and as with any other large purchase we ever make, I'm on one side of the dealership looking at an automobile that's completely different than the automobile she's looking at on the other side of the dealership. And of course, we come together and we're debating, we're each pleading our case of why the vehicle we have is better for the family. And she's saying, well, I have a lot of friends. My kids, our kids have a lot of friends, and we're always doing sports stuff. I think a minivan would be much more convenient. You push a button, all the doors fly open, and the kids go in. You push a button, all the doors close. It's awesome, which is true. Minivans are awesome nowadays. And of course, I'm talking with her about how we need a pickup so I can do yard work. We can haul the boat. It has the horsepower, while at the same time, it has the convenience of being able to do things, such as throw yard work in the back of the bed. But what do you think we compromised on? What do you think we went with? Many of the folks on the line, many of the guys on the line would say, well, definitely the minivan. Well, that's the way we usually compromise, me and my wife. What we ended up with was a sport utility vehicle. Why did we go with a sport utility vehicle? You see, we went with a sport utility vehicle. Why? Because it was versatile and flexible enough to where it had the power, which is what I was looking for, in order to haul the boat, which is our favorite hobby, but yet at the same time, that comfortability and safety of hauling multiple people, hauling 8 people, for example, it also had that. It had the safety of the minivan and the comfortability of the minivan, while at the same time it had the horsepower that I was looking for with that pickup truck. And by the way, the cost was pretty much the same as that pickup. It was the same as that minivan, and cost is always kind of the anchor, right? If you can't afford a $60,000 vehicle, then you better not be looking at $60,000 vehicles. So we went with that sport utility vehicle, and many have over the last couple decades. It's one of the fastest growing segments of the auto industry. Why? Because it's flexible enough and versatile enough that it handles both sides of the spectrum pretty darn well. Safety as well as comfort, as well as the horsepower, right? And the cost is about the same as a vehicle. The cost is about the same as a minivan. What I just explained there was the value triangle with automobiles. There's also a value triangle when you look at life insurance, universal life insurance specifically. So let's talk about GUL versus IUL in the context of this value triangle here. So you have this value triangle because there are always trade-offs, right? You can't have the cheapest product that has the most cash value with the longest guarantee. What we did is we took our foundation builder. We said, how does Bob and Nancy's scenario fit with the foundation builder versus the average of 13 of our competitors' GUL policies? And here's the value triangle. You can see here, in order to get a $500,000 death benefit on Bob, age 60, with that market average GUL, not Genworth, but the average of 13 of our competitors, it's $8,700. What about with our IUL illustrated at a 7% rate? Now 7% versus 6% versus 5%, we could talk about that all day long. We illustrated 7% here. I will say that illustrated at 6%, the cost is $8,000. So it's still around whatever that comes to, 9% cheaper than the GUL. So the first corner of the triangle here, whether it's 6% or 7%, you can see here that the foundation builder, the first of the three sides of the triangle, it wins, right? Now what about the safety and comfortability here? Well, you can see here that GUL, you have a lifetime no-lapse guarantee. So for Bob, that goes to 121. So if he lives until age 120 and passes away, Nancy's going to have that $500,000 death benefit. It comes at a cost though, right? An additional cost. What about the foundation builder? The foundation builder actually has up to a 30-year no-lapse guarantee. Now once they get over age 50, that no-lapse guarantee reduces by 1% per year. So it goes to age 80, right? So an age 51-year-old person, they're going to have a 29-year no-lapse. An age 52 person, a 28-year no-lapse. Bob, who's 60, is going to have a 20-year no-lapse. And by the way, the minimum no-lapse is 15 years. So this can actually issue on an 80-year-old. And what is the no-lapse guarantee on an 80-year-old? 15 years. It would take them until age 95. But in Bob's scenario, it goes until age 80, right? So this is a corner of the triangle where IUL does not win, right? But what about that third corner of the triangle? You know, think about this. What if Bob lives, say, 20 years or so? Bob lives 20 years. That house is paid off. The mortgage is paid off. And I actually have a GUL, and I'm kind of dealing with the same situation. What happens if you no longer need the death benefit as much as what you would like to have just money in your pocket? What happens when those needs change? I have a GUL that I bought about 10 years ago. Unfortunately, today, that GUL, I cannot replace it with this particular company. I cannot replace it with an IUL with that same company. So you can bet that I'm currently looking for IUL outside of that particular company. Why? Because look at GUL. GUL cash value is basically non-existent, right? 20 years into it, $25,000 cash value. 10 years into the IUL, $48,053, 20 years into it, they pay off the mortgage. You know what? They could effectively get their premium back in this scenario. So to where they paid in $147,280, they could take out, in this scenario, $150,905. And again, if you chose a 6% illustrated rate, yes, it would be a little more expensive, $8,000 a year. But over that 20-year period of time, it would also be a return of premium in that example. Now, it's not that the return of premium is a guaranteed provision in the policy. It's just that many times that is kind of the crossover point, year 20, with our foundation builder. So what you have here is two of those three corners of the value triangle. Many times you're going to find that the foundation builder wins two of those three corners of the triangle. And many times I get, well, you know what? What if the client, what if they just want perm term? What if, you know, basically term coverage forever is all that that client wants and they're willing to pay $8,749? I was actually in that position 10 years ago. Today I'm doing better financially than I was 10 years ago. Today I'm thinking, you know what, it would be nice to have tax-free distributions on that money because life insurance, I'm full of life insurance now. I don't really need a whole heck of a lot more life insurance, but it would be nice if what I paid into that policy, I had something to show for it. So even though the consumer thinks that their needs aren't going to change like I did 10 years ago, sometimes maybe it makes sense to enlighten them on the additional features. But there's one other feature that they can add to this particular policy. What it is it's long-term care. Think about this. Think about these statistics here. Imagine talking to a client about these statistics here. Mrs. Client, do you know that today there is a 1 in 240 chance that you're going to get in a car crash? There is a 1 in 240 chance you're going to get in a car crash today. There is a 1 in 1,200 chance that today your house is going to catch fire. There is a 7, or actually there is a 1 in 11 chance that you're going to be hospitalized today. Now those three risks, do you have any issues at all writing a check to an entity that will take those risks off the table? Again, 1 in 240 you're going to get in a car crash. 1 in 1,200 you're going to, your house is going to catch fire. 1 in 11 that you're going to be hospitalized today. No, you have no issues writing a check to an insurance company that is going to take that risk off your balance sheet, so to speak. What if I told you that there was a 7 in 10 chance that you're going to have a long-term care event, that you are going to need long-term care eventually if you're over the age of 65? What if I told you that? Would it be such a long putt then to maybe look at an insurance company to take that risk off the table? Well, you can have, Bob, in our example, you can have for the additional cost of $695 per year, which is only, what is it? It's around 8% probably on what the premium was. For an additional 8%, $697 per year, you can have that entire $500,000 death benefit opened up in the scenario that you cannot do 2 activities of daily living for at least a 90-day period of time. For just $700 more, you can have that entire $500,000. This is not death insurance like old life insurance was, right? Before, you had to die before somebody got the money. Today, life insurance is life insurance. There are actually living benefits that come along with life insurance. And this is an example of you not having to die in order for you or somebody else to get that $500,000 benefit. And that is the long-term care rider with Genworth that can be attached to this policy. And by the way, it covers not just a permanent need, but also a temporary need. So if you're doing chronic illness riders, that is a big distinction. The client does not have to have a permanent condition. If they cannot do 2 activities of daily living for at least a 90-day period of time, then they can trigger this rider. 3 calls to action here, and URL's number, I know that Matt's going to give it to you, but I'm going to give it to you anyway. And as soon as you hang up, make sure you call URL. If you're like me, you go back to what you were doing and you kind of forget everything, and it kind of takes a back burner. Their number at URL, which you probably have, but I'll give it to you anyway, is 1-800-926-8875. Now, 3 calls to action here. First of all, call URL to get an illustration, whether it's a death benefit case or whether it's an accumulation and distribution case. Make sure you get an illustration. Look at our illustration software here. Here you have a summary. So in this example, you have total premiums paid, $328,000, and I won't get into the example. You have total distributions to Heather in this scenario of $1.1 million. Well, how is it that we're able to do this, Mrs. Client? Well, it's not about the amount of return on your money. It's about the amount of money you're getting the return on. So you can see the mechanism in which we give the client up to a 14% cap. You have that interest crediting zone there. You have the market dropping in 2008 by 40%. Did the client lose 40%? No, they did not. So you have this wonderful illustration software. You know, if you were to die at age 85, how much money would you get in death benefit, or how much would be passed on to the heirs? How much would you have been able to take out up to that point in time in tax-free distribution? It shows all of this, and I think if you've been around IUL, you'd probably argue this is the best-looking illustration software out there. So call URL to get an illustration. Call URL to get the value triangle piece. So where I talked about the death benefit, the value triangle, we have pieces on that where you can introduce the trade-offs with universal life insurance to your consumers. Last and certainly not least, much of the stuff that I talked about here today is archived on a website, a special website, and it's also in video format on a website. We have a green room in Richmond where I fly out there every month or so and do videos. This website is this, www.genworth.com/Index Institute. So no ED after index, it's just Index Institute. So genworth.com/Index Institute. And Matt, I went probably about 10 minutes longer than I wanted to, so I'll hand it over to you at this point in time. I don't know if we have time for questions, but again, I do appreciate your time and everybody else's time. But at this point, Matt, I'll hand it over to you.
I appreciate it, Charlie. Thank you very much. There was a ton of information in today's presentation. Please take advantage of those action items that Charlie gave everybody here in today's call. If you do have questions, feel free to type those questions, and I'll read those questions aloud, and we'll get those questions answered. You can also raise your hand, and I can unmute your phone, and you can ask the question aloud. On your screen now, you'll see our contact information. Again, one of the action items is to call URL and have us run some illustrations for you. And we have other excellent marketing pieces available to coincide with today's presentation. Our toll-free number is 1-800-926-8875. My extension is 141. Steve Clemens is extension 132, and both are anxious to help you with your next life case and to run some illustrations for you. I do have a couple of questions that have come in here, Charlie. Let's see. This is from Harry. Harry asks, do you have a marketing program for max-funded indexed universal life to provide income?
A marketing program. I'm not sure exactly what he means by a marketing program, but we currently are in the process of developing like seminar material as well as scripts as well as PowerPoints, and probably what would come along with that would be invites. Do we have that right now? No, we do not, but I mentioned consumer research. This is what all of this stuff is going to revolve around, is what the consumers tell us via those little dials that works with them. So more forthcoming on that, and it's going to be powerful, not because it's some company people that developed it, but because it was originated from what the consumer's feedback was. Nothing now, forthcoming.
All right. And another question here. Does your illustration system calculate the internal rate of return on the cash value and the death benefit?
Yes, and I actually created our I didn't program it, but I told them the columns that we wanted in our IRR report. So yeah, at a certain age, imagine you illustrated at a 6% rate, but all right, Mrs. Client, so let's say that you pass away at this point in time, you've taken out this much income plus the death benefit is this. What if that internal rate of return showed that you know, the consumer or the beneficiary among those two got, say, 15% over a 15-year or a 30-year period of time? Would that be a feasible alternative to, say, a mutual fund? Or what if you basically spun down the entire death benefit and 5% is what the consumer got as a illustrated rate of return? Well, if I illustrated at 6 but the IRR was 5, what's the difference between the two? That's the expenses, right? Well, is 100 basis points expense, is that a huge amount? Is IUL astronomically expensive? No. So there are tons of ideas around the IRR report. Long answer, I know, Matt, but I'm passionate about that one.
I can tell you're passionate about indexed ULs and index products altogether.
Yeah.
If anyone has questions, feel free to type those questions. We'll give a couple more minutes here for people to either raise their hand or ask or type those questions. One of the things, and maybe this is a question for Rob, a couple of carriers within the industry have actually pulled their GUL off the table. One of them is Genworth. Where is there another GUL coming, or are we going to be using the Indexed UL platform as with a secondary guarantee, or is that kind of something Genworth's going away from?
Great question, Matt. Yeah, it has been an industry trend that we're seeing, and part of that's probably has helped the IUL marketplace with the carriers moving into those product directions. The IUL market is definitely less capital intensive for carriers, but it is the market that's been growing. It's not a new market. It's not a fad, and Charlie, jump in if you want. You know, the IUL marketplace has been here for 16 plus years, and it's going strong. I fortunately was able to get into it in the early stages of it and thoroughly have enjoyed the opportunities that these products present. Genworth has moved away from the GUL sales. Unfortunately, when we did take a look at our product, it was competitive in certain scenarios, but not extremely competitive as it used to be, and it really resulted in, you know, a very low sales volume for that product. So what we decided to do was really focus on the products of where we see the market going, and GUL is definitely not the market that's growing. It definitely seems to be going away. So we're really focusing on the two products that we offer now with the IUL, the accumulation and the longer guarantee, kind of the in-between, as if you will, of the foundation builder.
Okay. And there's another sales opportunity that kind of popped into my head, and this is for somebody that maybe your client is purchasing a universal life policy for the very first time. Maybe they're in their 30s or their 40s, and you get them a policy with a secondary guarantee, which is basically a permanent term policy. Down the road, there's a chance that they may need to either get more coverage, or that the policy is not, or they need to get more coverage. Well, if the policy doesn't have any cash value, you can't really do a 1035 exchange and help offset those premiums. Where doing an indexed universal life policy, there's cash value there that you can do a 1035 exchange and offset those costs as their insurance needs change. Just as Charlie mentioned before, whenever there is new debt, there's also a new need for life insurance, and this is just another opportunity, something to think of down the road. Instead of just making that sale and putting this person on the books with a permanent term policy, explain to them the pros and the cons, and the software with Genworth will do that for you. I'm not seeing any other questions coming in at this time. Again, our contact information is there on the screen for you. It's 800-926-8875. My extension is 141. Steve's is extension 132. You can also go to our website, URL, insgroup.com. Again, the temporary username, for those of you who are new to URL or kind of kicking our tires to access our website, the temporary username in lowercase letters is Grand, and the temporary password in lowercase letters is Cayman. Of course, that's where our trip will be in 2016, and we would certainly love to help you with your next life case and help you earn points and credits so that we can welcome you and a guest to the Cayman Islands. So I guess at this point, we'll wrap up today's presentation. Charlie, Rob, thank you very much for your time, and everybody that's on this call, thank you very much for taking time out of your schedules to join us today. I will be trying to touch base with the people on the call, and you can also give us a call as well, and we'd certainly like to help you we'd like to earn your business and help you with your next life case. Until next time, thank you very much, and have a great day, everybody.